Hello YouTubers, my name is Dennis Fugel, CPA, Chartered Professional Accountants, Winnipeg, Manitoba. Today I would like to continue my video on real estate. My first part was principal residency exemption, and the second I would like to continue about the topics that might be interesting to you or you should take in consideration. And today I will talk about multi-generational home and innovation tax credits and consequences, not only consequences, things that you should take when you in consideration when you renovating or renovating unit or adding unit to your existing. Okay, so what is multi-generational home and innovation tax credit? It was introduced in budget 2022, and it's allowing to the taxpayer to claim 15% tax credit from maximum of 50,000 of expenses. It means that if you did a renovation at home, and there's the rules, I'm going to give you the conditions when you can, but in general, if you spend 50,000 and less, you can up to 50,000 and less, you can take the amount that you spent, multiply by 15%, and this is going to be your refundable tax credits on your personal tax return. If you're going to ask me what happened if my renovation was above 50,000, 100, 200, perfectly good for you, but you only can claim up to $50,000. Maximum tax credit, refundable tax credit that you can claim is 7,500 because 50,000 multiplied by 15%, you can receive back 7,500 refundable tax credits. Now the conditions. The conditions in order to be in the program, in the program. It means that you creating or renovating unit, independent livable unit, has his own entrance, has his own kitchen, has his own bathroom, living space. Unit is independent. In the moment that you're creating unit like this, you may be eligible and may apply for this MHRTC credits. I'm always looking on the side because the screen is over there in order not to miss any of the important information. And the application is under section 122.92. This is CRA, Income Tax Act. It's saying exactly what are the conditions that you should stand. You should have a qualified person, qualified house. Everything's supposed to be qualified, like always. So when you qualified, then you can apply for this program, and this is what you can receive in return. Okay. Now second part. Second part is principal resident exemption, section 54. So when you have a real estate, when you have your own asset, we all know that when you're selling this, the gain that you earn is basically sheltered, not taxable. However, the question is, what's happened if you add additional unit to your house? For example, you have a nice big lot, and in this lot you have your house, and it's a lot that's so big that you can add another unit. And this unit can be for entertainment, and this unit can be for the kids, this unit can be for the parents that coming or living with you, and you want them to be with you, close to you, but not live with you, and you're adding additional unit. Okay? Then what's happening? Okay, because we know now you have two assets, two real estates on the same property. So the title is the same, everything is the same, but you have two units. And according to the Income Tax Act, Section 54, only principal residence is exempt. It means principal residence where you reside, where you live, where most of your life is going on. So if you're most of your life going on in the main home, not in an addition, it means only this home can be sheltered or protected from the tax. And you only can receive exemption on your principal home, where is you living, not on a secondary unit. Secondary unit is basically taxable. And let me give you numerical example. For example, you sold your asset for $1 million, okay? Where you have two units. Let's say 600,000 belongs to the main unit and 400 for the addition. So basically $600,000 going to be tax exempt. And for the $400,000 unit addition, you're going to need to pay taxes, okay? This is how it works. Now, majority of you, all of you, are going to say, well, how does CRA know? They will know. First of all, they have their own matching units that are going to match, that are going to investigate, and you don't want to mess with the CRA, first of all. Second, we always going by the law. Nobody gonna here cross the line and do whatever client ask you or telling you to do. Because in this case, we're jeopardizing our work, my profession, my laws that my profession imposed on me. So as a CPA, we have an obligation not only to my client, but also to communities that we serve. And we must obtain and go according to the law. This is one. Second, how you not avoid, but how you can shelter maybe your secondary unit. You need to prove to the CRA that this unit was integrated with your principal residency. And wow, integrated with your principal residency. Let me give you an example. For example, you have a house, main floor, and you have a basement. And you just renovated the basement. And you apply for the basement for the MHRTC program to receive this 15% back from the $50,000 because you did a renovation, walls, insulated walls, floors, kitchen, everything separate, interest, and it's applied. And your family enjoyed. So now you have house when two levels are livable, and in the basement it's your entertainment. You're going over there and you're playing with the kids, you're doing karaoke, you're spending a lot of time, and in the first place, and in the first level, you're just going to sleep and eat. But in the second level, you're having all the entertainment, you're spending a lot of time. So basically, the second level is fully integrated with your principal residency. You see what I mean? It's fully integrated. You are in both levels. You're coming and enjoying in the same time, and not only in the same time, you're enjoying in the same way like you're enjoying upstairs, you're enjoying downstairs. So the renovations that you did, the change that you did to your unit, all the family having fun and enjoying. It's fully integrated with your principal's residency. The same integration need to happen to the separate unit that you built. Now, how can you prove that the second unit is fully integrated with your principal residency? It's totally different story. And this is maybe you build a hallway between main house to the second unit, and you're walking and you're enjoying. Yeah, never saw it. It's not a mall when you're building hallways between the building. Never saw it. At least I never saw it in my life. Maybe somebody else did, and it's okay for him. Good for you. But for the majority, let's say, majority of the population, I did not saw any houses that building huge hallway between main principal residency to the another unit that they bought few like 50, 70 yards away from the main unit in order to connect them, and now you can claim huge money. So only in this situation, when you can prove that your addition is fully integrated, like in my example, first floor and the second floor, fully integrated with your main residency, only then you can shelter the gain from the sale of the real estate. How it can be done? It's hard. And usually say, one more thing. If you claim this tax credit that I told you about multi-generational housing, okay? Multi-generational home renovation tax credit. If you claim credits in the past for your renovation, okay? You have separate entries, you have separate independent units, it have a kitchen, it have a bathroom, it have a living space and a room to sleep on, perfectly. And then suddenly you start renting it out. In the moment that you rented it out, you cannot shelter gain on a sale of this unit because this unit start bringing you money. It start bringing you money. You have a business right now, rental business, whether you like it or not. So this is a trick. For you remember my example when you have a first floor and then a second you renovated and you renovated your basement. It's now it's independent unit. Let's say for example, you rented out your basement and you did participate in the program. Okay, so if you did participate in the program and you claim tax credits, it means when you're selling your house, it's basically two floors. The first floor, principal residence, and its principal residence exemption applied. The second floor, not applied. You need to pay tax And this is what the law says, okay? The law says that you need to pay tax on a rental. There will be capital gain, and with today's new rules on the capital gain, which portion is exempt, which is not exempt, what is percentage of exemption portion, and etc., etc., etc. So it's maybe look weird or unwise. How come it's only one house and in the first floor I'm living, second I'm renting? Yes, first floor is your principal residency, second is not. That's why it is taxable. Okay? It's easy to understand when you have separate unit away from your house, one you're living, one you're renting. It's also not questionable because one producing for you an income and it's not tax sheltered. Yes, same title, same address, everything is the same. But one is principal residency and the second was income producing unit for you. By the way, also see they're looking on things like address, to utility bills, utility accounts, everything is the same, and then there will be determination. But there is actually rules and conditions that CRA says that need to apply, and they need to be have, or you don't need to have, in order to be principal residency or not to be principal residency. Okay? So I want you to know, and you should take in consideration, if you have participated in the program and you ask for the multi-generational home renovation tax credits. It's a good program. You can receive maximum in the net $7,500 taxes, refundable tax credit in your personal tax return. It can help you, but if you rented out this part, any incomes that come from and the unit himself when you're selling it, unit is taxable. Okay? If you have one lot and you have two units, two independent units, the ones that you're living in is residence, principal residency, and it's going to be exempt in the days that you sell it. The other unit, even if you did not rent it, it was for pleasure, maybe parents to come to live, stay, it is taxable because principal residency exemption only for one real estate asset in your hand. And it's not one, you have two. You created two houses. It means you have two assets in your hands. And Section 54 for the Income Tax Act define and explain it beautifully and clearly what is it. So please take it in consideration next time when you're trying to purchase something or you are trying to add to your property. Take in consideration that there might be in the future tax consequences. Okay? And if you would like to receive more information about it, please go to your local CPA and he can gladly explain you what are the conditions and what can be, what you should look at and be aware of. Please write me comments to my videos. You can write me also an email in info at alphabetacpa.ca. You can also go to my website alphabetacpa.ca. You have over there my phone number and my email. You can email me or phone me directly and I will gladly help and answer any of your questions. If you have any comments, please leave, subscribe to my channel, and I will be happy to do a video for any of the topics that you're suggesting. Have a nice day. Bye-bye.